stocks still have a lot of upside into year-end. That's the line, straight from Fundstrat's head of research and CIO Tom Lee, after laying out why AI capex and a more dovish Fed could keep this market climbing into Q4. He's also calling for a broader rally beyond the usual mega caps, with financials set to benefit as the cycle turns, and he's leaning into blockchain as a real efficiency play inside finance. In today's video, I'm going to roll Tom Lee's CNBC clip, then give you my reaction and break down exactly what his framework means for your portfolio, what to watch in the data, how I'm thinking about sector rotation, and where the risks actually live. And after that, I'll walk you through my in-depth analysis of 3 leading tech names I believe are best positioned to ride this AI investment wave into year-end and beyond. If you only watch one market video today, make it this one, because the setup into Q4 could be bigger than most people think. Before we jump in, tap like so more investors see this, drop a comment with your take on Tom's call, and subscribe so you don't miss the next update. Alright, let's hear what Tom Lee has to say. Here's the big picture. Tom's argument rests on 2 pillars. First, there's a powerful capital expenditure tailwind coming from AI. Companies are still in the early innings of spending on data centers, chips, networking, software, and the services around them. That capex doesn't live in a vacuum. When hyperscalers and enterprises invest, the ripple touches semis, electrical equipment, utilities, real estate, logistics, and professional services. Second, the Fed has been on hold for 9 months and is leaning more dovish than markets feared a few months ago. Put those together and you've got a macro background that, despite headline worries like a government shutdown, still supports risk assets. Let's unpack the dovish point because that colors everything else. Tom's making a practical observation. A shutdown, or even the threat of it, tends to dent confidence and temporarily interrupt parts of the economy, especially if data releases get delayed. In that environment, the Fed is less likely to turn hawkish. If anything, it softens its tone. Even without a shutdown, he thinks policy is already restrictive enough to keep inflation trending lower, while growth avoids a cliff. In plain English, we've got tighter money than normal, but not so tight that it kills the cycle, so the Fed can sit tight or tilt dovish, which is equity-friendly. Now connect that to his manufacturing call. He points out that ISM manufacturing has been below 50, contraction territory, for 31 months, the longest stretch on record. Why should you care? Because the ISM isn't just a vibe check, it correlates with earnings growth and risk appetite. When it flips back above 50, that's usually the baton pass from a narrow leadership market to a broader one. In Tom's playbook, a move back into expansion would be a green light not only for tech to continue, but for financials and small caps to play catch-up. Think of it like this. We've been driving on one lane dominated by mega-cap tech. An ISM expansion opens more lanes so other groups can accelerate too. He also leans on seasonality. Since 1950, Q4 averages about a 5% gain. Seasonality isn't destiny, and he admits this year has unique risks, but he makes a compelling counterpoint. Sentiment remains muted despite a strong market. He calls it a most hated V-shaped rally. If investors are still skeptical after a big run, there's dry powder and FOMO can work in bulls' favor into the holidays. That skepticism shows up in survey data and positioning. People haven't gone all in, which leaves room for incremental buyers if data doesn't break. Valuation is the pushback everyone has, and Tom addresses it head-on. He notes that headline names like Nvidia are around the mid-20s on a price-to-earnings basis, which, relative to growth, isn't nosebleed territory. Whether you agree with the exact multiple, the core idea is this. If earnings continue to expand, powered by AI capex and a less hostile Fed, then today's multiples compress on higher E, or at least stop expanding, which helps total returns. In other words, valuation risk eases if profit growth outpaces price. Let's talk sectors, because he made a specific call, financials. The logic is twofold. 1, a more dovish Fed and any steepening of the yield curve help bank profitability over time. 2, he sees AI as a real earnings driver inside the industry. Fraud detection, underwriting, customer service automation, claims processing, compliance and back-office automation can all move the expense and loss lines. If you believe banks can use AI to structurally improve efficiency ratios, you start to see a path to multiple expansion, not just cyclical rebounds. He then stretches that tech thesis into blockchain rails, with a particular nod to Ethereum. The argument, financial services are gradually building on chain to reduce costs and increase speed and transparency. and that shift could warrant more tech-like valuations for parts of finance. He cites Tether as an exhibit of how a blockchain-native financial business can scale revenue with far fewer employees than a legacy bank. Now, a quick reality check from me. Stablecoins, market caps, and earnings claims can get messy, and comparisons to the size of major banks can mix apples and oranges. The spirit of his point, though, is about operating leverage. Software-driven financial infrastructure can achieve revenue per employee and margins that look more like tech than traditional financials. If you buy that, the long-run re-rating case isn't crazy. How do these threads tie together for the rest of the year? In Tom's framework, you've got three reinforcing forces. AI CapEx drives top-line growth in tech and its supply chain. A dovish-leaning Fed cushions the cycle just as sentiment is still skeptical. And a potential ISM re-acceleration unlocks a broadened rally across small caps, financials, transports, and cyclicals, while not killing the tech trade. That's how you can get a year-end push even with macro noise. Here's how I'm translating that into a practical reaction for investors watching this. First, watch the ISM manufacturing print like a hawk. A decisive, sustained move above 50 is your signal that breadth can widen. If that happens, I'd expect small caps and cyclicals, especially economically sensitive groups, to outperform in spurts. If ISM rolls back over, the broadening narrative pauses and leadership likely stays concentrated. Second, listen to the Fed's language around higher for long enough. If they emphasize progress on inflation and the risk of over-tightening, that's dovish. A benign dot plot and careful rhetoric at upcoming meetings keeps the soft landing tape intact. A surprise hawkish pivot would be your risk-off cue. Third, on AI CapEx, look for tangible follow-through in orders and backlogs across semiconductors, power equipment, grid upgrades, optical networking, and data center reites. Management commentary about multi-year visibility is gold. If that pipeline stays intact, it underwrites the growth side of the multiple debate. Fourth, for financials, focus on two things: credit and costs. A clean credit picture and clear AI automation wins showing up in non-interest expense can support Tom's case. I'm also watching the yield curve. Steepening over time is a tailwind, but the path can be choppy. Near term, management guidance and bank earnings will tell you whether the worst of NII compression is behind us. Fifth, on crypto and Ethereum rails, I'm treating that as a secular optionality rather than a base case. If more blue-chip financials roll out real products, custody solutions, or tokenized assets on chain, that supports the thesis. But this one is still path-dependent on regulation and execution, so I'd size it accordingly. Let's address the obvious risks Tom acknowledges but doesn't dwell on. A prolonged, messy shutdown that tangibly hurts growth and confidence longer than markets expect could challenge the soft landing story. Re-acceleration in inflation would box the Fed in. Geopolitical shocks can always overwhelm seasonality. And, on valuations, if earnings disappoint, especially in the AI complex, multiples can compress fast. None of these are my base case today, but they're on the dashboard. So where does that leave us? My takeaway from Tom Lee's interview is a constructive but disciplined stance. Lean into the idea that Q4 can work, not just for mega-cap tech, but for parts of the market that lagged, financials, select cyclicals, quality small caps, while still respecting the AI backbone that got us here. Use pullbacks to build exposure rather than chase breakouts blindly. Let the data, ISM trends, Fed tone, order books, and bank guidance confirm the story. If we see ISM flip above 50, a steady dovish tilt from the Fed, and continued AI CapEx receipts, then Tom's broad-based rally into year-end call has legs. If those signals fade, stay anchored in the strongest earnings visibility, still largely the AI supply chain, and keep some dry powder. That's how I'm synthesizing his views into an actual game plan, and that's how I'll be positioning and updating you as new data comes in. Now let's dive into the 3 leading tech stocks to buy. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. First up is ARM Holdings. ARM. If you've been following the tech world, you've probably heard the name, but you might not realize just how deeply ARM's technology is woven into the fabric of our digital lives. ARM is the silent powerhouse behind the devices we use every day, and its influence stretches far beyond what most people imagine. If you've used a smartphone, tablet, or any modern connected device, you've almost certainly interacted with ARM's technology, whether you knew it or not. The same goes for laptops, where ARM's designs are increasingly powering new generations of ultra-efficient lightweight computers. But here's the twist. ARM doesn't actually manufacture chips themselves. Instead, they focus on designing the blueprints, the intellectual property, that makes these chips so powerful and efficient. They then license these designs to industry giants like Apple, Samsung, and Qualcomm, who use them as the foundation for their own custom chips. This business model is incredibly powerful. ARM collects upfront licensing fees from companies that want to use their designs, and then earns ongoing royalties for every chip sold that's based on their technology. It's a model that scales beautifully, allowing ARM to profit from the explosive growth of the entire electronics industry without the massive capital costs of manufacturing. The result? Over 99% of smartphones worldwide are powered by ARM-based processors. That's not just dominance, it's near total market saturation. Whether you're using an iPhone, a Samsung Galaxy, or a budget Android device, there's a very high chance ARM's technology is at the heart of it. But ARM's reach doesn't stop at phones. Their designs are the backbone of a vast array of consumer electronics, from smart TVs and streaming devices to car dashboards and smartwatches. Their ultra-efficient, low-power designs are perfect for smart TVs in your living room, wearables on your wrist, the digital dashboards in modern cars, and the billions of Internet of Things devices quietly running in the background of our homes and cities. From smart thermostats to connected security cameras, ARM is everywhere. Now, ARM is setting its sights on an even bigger prize, the data center and cloud computing market. As the world's demand for data explodes, so does the need for servers that are both powerful and energy efficient. This is where ARM's expertise in low-power design becomes a game changer. Tech giants like Amazon and Microsoft are now building their own ARM-based chips for use in massive data centers. Their goal? To achieve better performance per watt, lower energy costs, and reduce their environmental footprint, all while handling the ever-growing demands of cloud computing. This shift opens up a massive new revenue stream for ARM. As cloud adoption accelerates globally, the number of ARM-powered servers is set to soar, and with it, ARM's royalty income. The company is positioning itself at the heart of the next wave of digital infrastructure. And then there's the AI revolution, a once-in-a-generation opportunity. Artificial intelligence is rapidly moving from the cloud to the edge, meaning more and more AI processing is happening directly on devices, not just in distant data centers. ARM's low-power chips are tailor-made for this new world of edge AI. Think smart security cameras that can recognize faces, voice assistants that understand you instantly, and industrial sensors that analyze data in real time, all powered by ARM's efficient designs. As AI becomes embedded in everything from household gadgets to industrial robots, the demand for ARM-based chips is set to skyrocket. The company is already working with partners to develop next-generation AI accelerators, ensuring they stay ahead of the curve as this market explodes. One of ARM's greatest strengths is its neutrality. Unlike some competitors, ARM doesn't compete with its customers. Instead, it acts as a trusted partner to everyone from Apple and Samsung to Qualcomm and countless others, enabling them to innovate on top of ARM's foundational technology. This approach has created a massive interconnected ecosystem. The more devices that use ARM's technology, the more attractive the platform becomes for software developers, which in turn attracts even more device makers. It's a self-reinforcing cycle that's incredibly hard for competitors to break. Financially, ARM enjoys software-like profit margins thanks to its licensing model. Most of its costs go into research and development, fueling constant innovation and keeping ARM at the cutting edge of chip design. This focus on R&D is what allows ARM to stay ahead of both established rivals and upstart challengers. Of course, ARM's stock isn't cheap. Investors are paying a premium for the company's dominant position and future growth prospects, especially in data centers and AI. But for many, the potential rewards justify the price tag. There are risks, of course. Open-source competitors like RISC-V are gaining traction, and ARM does have some customer concentration risk, but the sheer scale of ARM's ecosystem combined with its decades of expertise gives it a formidable moat that's not easily breached. In summary, ARM Holdings is a foundational technology company. It has a near monopoly in mobile, is rapidly expanding into cloud computing and AI, and is built for long-term sustainable growth. Its technology is the backbone of the digital age. If you're looking for exposure to the picks and shovels of the digital revolution, the essential tools that power everything else, ARM is a company you'll want to keep a close eye on. Its influence is only set to grow as our world becomes ever more connected and intelligent. Let's move to our next tech innovator. Next, let's talk about the Trade Desk, often referred to as TTD, a software powerhouse that's quietly become one of the most influential players in the world of digital advertising on the open internet. While it may not be a household name like Google or Meta, the Trade Desk is the engine that powers a huge portion of the ads you see every day as you browse the web, stream your favorite shows, or use mobile apps. Their technology sits at the heart of the digital advertising ecosystem, connecting brands with audiences across a vast and ever-expanding digital landscape. While Google and Meta dominate their own closed platforms, what the industry calls walled gardens, the Trade Desk empowers brands and agencies to buy ads across the rest of the open internet. That means news sites, streaming services, gaming platforms, podcasts, and mobile apps, essentially everywhere else online that isn't owned by the tech giants. This open approach gives advertisers access to a much broader audience and a more diverse set of ad opportunities, making the Trade Desk a critical partner for anyone looking to reach consumers wherever they are. At the core of the Trade Desk's offering is its demand-side platform, or DSP. This sophisticated software lets advertisers target audiences with incredible precision, using real-time data and advanced algorithms to reach the right people at the right moment. Marketers can analyze performance, adjust campaigns on the fly, and optimize their ad spend for maximum impact. The platform's intuitive interface and powerful analytics tools have made it a favorite among digital marketers who want to make every advertising dollar count. One of the most important things to understand about the Trade Desk is its independence. Unlike some competitors, the Trade Desk doesn't own any ad inventory. They don't have their own websites or apps to fill with ads. Instead, their only goal is to maximize value for advertisers and agencies. This neutrality means they're fully aligned with their clients' interests, and it's a big reason why so many brands trust them to manage their digital ad campaigns. One of the biggest growth drivers for the Trade Desk in recent years has been the explosive rise of connected TV, or CTV, as millions of viewers cut the cord and shift from traditional 𝗗𝗚𝗧 into streaming platforms. Advertisers are following suit, moving their budgets to where the audiences are. The Trade Desk has positioned itself at the center of this shift, capturing a significant share of the ad dollars flowing into streaming and on-demand video. Their platform brings the power of data-driven targeting and measurement to TV advertising, something that was nearly impossible in the old world of broadcast. Now, brands can deliver highly relevant ads to specific households, track performance in real time, and adjust their strategies to maximize results. For viewers, this means seeing ads that are more relevant and less repetitive, while brands get more bang for their buck. But the digital advertising world is changing fast, especially when it comes to privacy. With third-party cookies disappearing and new regulations on the horizon, advertisers need new ways to identify and reach their audiences. The Trade Desk has taken a leadership role here with Unified ID 2.0, a new privacy-conscious standard for online identity that's gaining traction across the industry. Unified ID 2.0 is designed to give consumers more control over their data, while still enabling effective advertising, and it's being adopted by publishers, advertisers, and tech partners worldwide. The Trade Desk's business model is refreshingly straightforward. They take a small cut of every ad dollar that flows through their platform, so as digital ad spending continues to grow, driven by trends like streaming, mobile, and global internet adoption, so does the Trade Desk's revenue. This model creates a powerful flywheel effect. More advertisers mean more spend, which means more data, which in turn makes the platform even smarter and more attractive to new clients. A big part of what makes the Trade Desk's platform so effective is its use of artificial intelligence. Their AI engine, called 𝗗𝗦, automatically optimizes campaigns by analyzing vast amounts of data in real time. 𝗗𝗦 can predict which audiences are most likely to engage, adjust bids on the fly, and recommend strategies to improve performance. By integrating both first-party and third-party data, the Trade Desk gives advertisers a 360-degree view of their audiences, making targeting smarter and more efficient than ever before. The results speak for themselves. The Trade Desk has delivered rapid revenue growth year after year, with high profitability and customer retention rates consistently above 95%. Their clients stick around because the platform delivers measurable results and keeps evolving to meet the changing needs of the digital ad market. Investors have taken notice, and the Trade Desk's stock has become one of the standout performers in the tech sector. Of course, all this success comes at a price. The trade desk isn't a cheap stock by traditional valuation metrics, but it's a clear leader in a massive, expanding market. For investors looking for exposure to the future of digital advertising, the trade desk offers a compelling combination of growth, innovation, and market leadership. There are risks, of course. Regulatory changes could impact how digital ads are bought and sold, and competition from tech giants is always a threat. But the trade desk's focus on the open internet, its proactive approach to privacy, and its reputation for transparency set it apart from the pack. The company is constantly innovating to stay ahead of industry shifts, and its leadership team has a track record of navigating complex challenges. Looking ahead, the trade desk has plenty of runway for growth. International expansion is a major opportunity as digital ad markets in Europe, Asia, and Latin America continue to mature. The company is also forging new partnerships in the fast-growing world of retail media, helping brands reach shoppers across e-commerce platforms and in-store digital displays. These moves position the trade desk to capture even more of the global digital ad spend in the years to come. In short, the trade desk is the backbone of programmatic advertising beyond the walled gardens. It's the technology that enables brands to reach consumers wherever they are, with the right message at the right time. For anyone betting on the long-term growth of digital advertising, the trade desk stands out as a top pick, combining scale, innovation, and a unique position at the center of the open internet. Now, let's turn our attention to another critical player in the digital ecosystem, the company building the cloud's nervous system, powering the infrastructure that makes all of this possible. Our third company is Arista Networks, ticker symbol ANET, a true pioneer in high-speed networking technology that's become the backbone for the world's largest and most advanced data centers. Arista's cutting-edge switches and software are the invisible force powering the digital experiences we rely on every day, from streaming video to cloud computing and artificial intelligence. In a world where data is growing at an exponential rate, Arista's role is more critical than ever. Arista's customer list reads like a who's who of the tech world. Microsoft and Meta, two of the largest cloud and social media giants, depend on Arista's networking gear to connect tens of thousands of servers in their hyperscale data centers. These are the digital factories of the modern era, and Arista's technology ensures they run smoothly, efficiently, and at lightning speed. The trust of such industry leaders is a testament to Arista's reliability and performance. But what really sets Arista apart from the competition is its software-first philosophy. While many networking companies focus primarily on hardware, Arista has always believed that the future of networking lies in intelligent, flexible software that can adapt to rapidly changing needs. At the heart of Arista's innovation is the Extensible Operating System, or EOS. This powerful software platform runs consistently across all of Arista's products, from the smallest edge switch to the largest core router. EOS makes it dramatically easier for IT teams to manage complex networks, automate routine tasks, and reduce the risk of costly human errors. Its modular design means new features and security updates can be rolled out seamlessly, keeping networks secure and up-to-date. EOS's open programmable architecture is a game-changer for customers. It empowers organizations to automate and customize their networks to fit their unique needs, an absolute necessity for today's massive, fast-growing data centers. Whether it's deploying new applications, scaling up to handle more users, or responding to security threats, Arista's software gives customers the agility and control they need to stay ahead. When it comes to raw speed, Arista is at the forefront of high-speed Ethernet technology. The company has been a leader in the transition from 100 gigabit to 400 gigabit Ethernet and is already preparing for the next leap forward. This relentless push for faster, more reliable networking is essential as the world's appetite for data continues to explode, driven by everything from video streaming to cloud gaming and most notably, artificial intelligence. The rapid growth of AI is a massive catalyst for Arista's business. Training large language models and running advanced AI workloads require enormous amounts of data to move quickly and reliably between thousands of servers and GPUs. This is where Arista's high-performance networking solutions truly shine, enabling the next generation of AI breakthroughs. In these AI-driven data centers, ultra-fast, low-latency networking isn't just a luxury, it's a necessity. Arista's expertise in building robust, scalable networks makes it the go-to partner for companies pushing the boundaries of what's possible with artificial intelligence and machine learning. While NVIDIA's InfiniBand has long been a standard for high-performance computing, Arista's Ethernet-based solutions are rapidly gaining ground. Ethernet's open standards, flexibility, and cost-effectiveness give Arista a significant long-term advantage, especially as more organizations look to avoid vendor lock-in and build future-proof networks. Arista isn't just a hyperscale data center story. The company is aggressively expanding into enterprise and campus networking, taking market share from legacy players like Cisco. as businesses of all sizes modernize their networks to support cloud applications, remote work, and digital transformation, Arista's solutions are increasingly in demand. Financially, Arista is a powerhouse. The company boasts impressive revenue growth, industry-leading profit margins, and a fortress-like balance sheet. With no debt and a substantial cash reserve, Arista is well-positioned to invest in innovation, weather economic storms, and return value to shareholders. Its consistent profitability and prudent management have made it a favorite among long-term investors. Arista's relentless focus on engineering excellence and meeting customer needs has earned it a fiercely loyal client base and a reputation for industry-leading innovation. The company's culture encourages collaboration, creativity, and a commitment to solving the toughest networking challenges. While customer concentration, relying heavily on a few large clients, remains a risk, Arista is actively diversifying. The company is winning new enterprise and cloud customers across industries, from financial services to healthcare and education, broadening its revenue base and reducing dependence on any single partner. The stock does trade at a premium valuation, reflecting Arista's leadership in the ongoing build-out of cloud and AI infrastructure. Investors are willing to pay up for a company with such a dominant position in a market that's only getting bigger. In summary, Arista Networks is much more than just a networking company. It's the digital backbone of the modern cloud and AI revolution. With best-in-class technology, a visionary leadership team, and a massive runway for growth, Arista is poised to shape the future of how the world connects, computes, and innovates. For investors seeking exposure to the infrastructure that powers our digital future, from AI to cloud to next-generation enterprise networks, Arista Networks stands out as a compelling forward-looking choice. There you have it, ARM Holdings, The Trade Desk, and Arista Networks, three tech leaders at the heart of the digital revolution. From chip architecture to digital ads to cloud networking, these companies are building the future. Every investment has risks, so always do your own research. But the long-term potential here is huge. Want deeper analysis and exclusive stock tips? Join the Stocks Galore Patreon, link in the description. Now I want to hear from you. Which trend, ARM's expansion into AI, the Trade Desk's programmatic ad growth, or Arista's AI networking, has the most explosive potential? Drop your thoughts in the comments. Don't forget to like, subscribe, and share for more investing insights. Thanks for watching. See you in the next one.